Well, after the two-day holiday, financial markets are open for business again. What should we be looking out for the rest of the week and possibly the year? We have Akintoye Oyeleku, investment analyst at Codros Asset Management Limited. Good morning, Akintoye. Hello, good morning, Akintoye.
Okay. Seems we don't.
Oh, we seem not to have Akintoye there. Well, let's look at. Good morning, Akintoye. Good morning, Akintoye.
Can you hear me?
Okay.
Yes, we can. Akintoye, yeah, if you can hear me now, the financial market has been dominated with mixed sentiments, especially after the last auction results showed a successive moderation in the stop rates following the outcome of the Treasury bond market auction by the DMO. What are your expectations about the fixed income market?
All right. So, yeah, so what we are seeing, the pattern we are seeing in the fixed income market is similar to what we have seen through the year. You will recall that at the beginning of the year, we saw that yields started rising in the money market space, especially for treasury bills and also OMO bills. We saw that yields started increasing, and then investors started to price that into bond pricing. So we saw that yields have risen since the beginning of the year, and now we are starting to see a moderation at the money market. For instance, at the treasury bills market, in the last 4 or 5 auctions that we are seeing average stop rate for treasury bills continue to decline. And, you know, investors have started to price that into the bonds auction. If you look at the last bond auction, we saw that yield across all the instruments that were offered saw declines from the previous levels. And again, when you observe the total that was offered for subscription, it was around 150 billion. But the DMO actually allocated around 130 billion, implying that the DMO is not willing to, continue to increase rates at the bond auction. So this means that what we are likely going to see for the fixed income market would be that yields will trend lower from the peak that they have gotten to since the beginning of the year, especially when you factor in the high system liquidity and also the fact that the DMO will be looking at reducing the cost of borrowing, since there are still a lot of planned borrowing for the remaining part of the year.
All right. How would the current developments in the fixed income market shape performance of the equities market in the third quarter?
Yeah, so it's just going to be a reverse. If you recall, at the beginning of the year, the equities market started out on a positive note, recording around 4% gain. However, when we started to see yields trend higher, we saw that investors maintain a risk-off sentiment for the equities market, and then we saw a lot of buying interest in the fixed income market. But now that we are expecting yields to trend lower for fixed income markets, given the high system liquidity and the drive for reduction in the cost of debt to the government, we're likely going to see that investors will now be monitoring development in the equities market, especially when you consider again that we are currently in the earnings season. Investors will be looking at stocks that are going to offer them very good dividend yield, and also stocks that are expected to perform well that are going to perform well in the half year. So this will be majorly it's going to be majorly a positive impact on the equities market for the third quarter.
Now, considering the existing market conditions, what would you advise investors in terms of taking positions for their portfolio holdings based on the expected performance of the financial market?
Yes, so there are many opportunities at the moment. For instance, we expect yields to trend lower in July, given high system liquidity, and even for the remaining part of the year, we are going to see some kind of low yields. Maybe sometime in the first quarter, we might see yields trending high again. But looking at the third quarter, investors could take position into bond instruments and other fixed income instruments as we expect yields to trend lower, given the system liquidity that is expected to hit the market in the near term. So for the equities market, like I mentioned earlier, investors should look at the dividend yield opportunity and also and they need to analyze the performance of the companies, and then based on this, look for fundamentally sound stocks that will offer them a good dividend yield. So investors could also take position in fundamentally sound stocks. And lastly, for investors that have a medium to long-term investment objective, they could look into exposing their portfolio to dollar assets or other more stable currency. This is because of the fact that we saw the impact of COVID-19 on Nigeria's FX stability in 2020, and looking at what we currently have, the issues have not changed. Nigeria is still likely dependent on oil, which means that whenever the global economy suffer another shock, Nigeria will likely still suffer from FX scarcity, which could prompt a devaluation or depreciation. As a result of this, investors could take position in USD denominated assets such as Eurobond. Although for investors that do not have the capital to acquire Eurobond into their portfolio, they could look at purchasing dollar funds, which are less costly, to diversify their exposure. A better decision for investors would be balancing between all these investments that I've discussed, having an exposure to the equities, to the fixed income instrument, and also to foreign currency instrument, based on their risk appetite.
All right. So the Monetary Policy Committee is set to meet on Monday to discuss policy direction of the economy. Given their previous stance on key policy metrics, are you anticipating changes in the decision?
Yeah, so basically, in the last meeting that was held in May by Monetary Policy Committee, some of the factors that shaped the decision to hold rates for the fact that there was a moderation in inflation numbers, and also there was what's it called now? There was a expectation that with the weak base effect of Q2 2020, and with the economy already reopened now, we are going to see some level of improvement, in activities which should drive the GDP performance, and also when they consider the weak growth of the fourth quarter of 2020 and the first quarter of 2021, they decided to leave this rate at they decided to leave the key policy metrics at their current level. So what we have again is that for the third quarter of 2021, compared to third quarter of 2020, we still had a weak base in 2020, even though it was better than the Q2 2020, given the fact that we saw a reopening of the economy in the third quarter. So there's still going to be a weak base, which will support the CBN to hold key policy rate. And also, if you notice the inflation figures, now we have seen that the inflation numbers are moderated, given the high base effect, although it doesn't reflect what is currently happening, on a month-on-month basis. So looking at all these factors, there's a high tendency that the central bank will likely hold the key policy metrics again when they meet next week.
Now, for most of part of the year, the external reserves have sustained the downward movement regardless of the development in the crude oil market. Since the beginning of the year, the foreign reserve dropped by about 6.4% to settle at $33.1 billion. Now, why are we not seeing the positive impact of the oil demand recovery on the reserves?
Yeah, so basically, like you mentioned, there has been a sharp decline in the external reserve, although if you want to assess it more closely, you will see that since the beginning of the year, the central bank has continued to improve the supply of FX across the major FX windows. For instance, if you look at the I&E window, in the beginning of the year, we had around $50 million daily average turnover in the I&E window. However, when you look at it till the current figures, we have around 140 million, which represent daily average that has been done in the I&E window, mirroring the increase in dollar supply to that segment. So basically, the increased supply of dollar to FX segment has led to contraction in the foreign reserve balance. Again, in the second quarter, OPEC had Nigeria to meet a maximum of 1.4 million barrels output per day for crude oil. However, Nigeria was not even able to reach that level, given the deficiency in the equipment that used to produce oil. So this affected our ability to optimize oil revenue in that period. Looking at the last OPEC meeting, OPEC has now allowed Nigeria to produce up to 1.8 million barrels per day, which means that Nigeria will start to see more significant inflow from oil, especially if you consider the fact that this is going to be starting in August, which is just next month. So this is positive for Nigeria. Again, Nigeria is expected to borrow around $6 billion for the remaining part of the year. So representing the external reserve balance, external loans, which will support an accretion in the external reserve balance. So overall, this will impact in the FX looking at the remaining part of the year.
All right, I guess we'll leave it there now, Akintoye. Thank you so much for your time on the program. Akintoye Oyelakun is the investment analyst, Cordros Asset Management. Thank you so much.
Thank you.